Good morning, everybody. I wanted to send a quick video out, regarding what's going on in the banking sector here over the last few days. There's with certainly the seizure of Silicon Valley Bank, last week, and then things now coming out with both Credit Suisse this morning, and then the other signature bank, there in New York as well. So, a couple of real quick things. One sort of what happened, give you a little bit of idea. So, Silicon Valley Bank, mostly in a classic sense, you could say it was a run on the bank. Depositors were withdrawing money in mass. Largely, Silicon Valley Bank worked with a lot of tech companies, and obviously, tech had been what was beaten up the most, over the last year. Then with additional layoffs and so forth. Also, with Silicon Valley Bank, there were some basic, very simple, but unfortunately, very significant, things that they did wrong. Even though rising interest rates were on the wall for the last 18 months, they proceeded to tie up a lot of their money in very low yielding treasuries, or they did what is called chasing yield. They went out in maturity to try to get just a little bit better interest rate or rate of return. Well, what happened as rising interest rates went up, all of those securities that they bought and owned, were drastically went down. And so in order to recoup that or to have cash available, they tried to sell stock, equity in the company. That didn't go well. So therefore, they were forced to then sell those securities at a much discounted rate. And when that was coming to light, then because they worked with a lot of tech companies, even some of the big hedge fund directors or people in the tech space recommended that companies withdraw their money from Silicon Valley Bank. And that's what led to the big run on the bank and ultimately their shutdown. So the FDIC insurance, that covers up to $250,000 per account per registration. I'll touch on that more in just a second. But since what Silicon Valley Bank dealt with was mostly a lot of corporate accounts, the majority of those accounts were well above $250,000. Ultimately, the bank stepped in and said, okay, they're going to make all bank depositors whole. Obviously, stockholders and bondholders of the bank will not be made whole, but the actual depositors will. Now we're playing semantics because on the one hand, Janet Yellen came out and said, we're not going to bail out the banks. Obviously, on the other hand, that's sort of precisely what they are doing. They're using a small loophole, in some of the FDIC insurance language, to do it, where the deposits are really going to be made whole based on what banks have to pay in for FDIC insurance anyway. So in one sense, we can all see our bank fees will probably go up in the future to cover this as well. Also, regulators over the weekend seized a New York-based signature bank. While not the underlying cause of their demise, Signature Bank had begun to become a more or a bigger player in the crypto markets, and therefore that led to some of that volatility, as well. And so, same thing applies. The FDIC will ultimately make all the depositors of Signature Bank whole as well. And that brings us to this morning. So this morning it came out Credit Suisse was needing to raise capital. Obviously, as a larger global bank, the news of Credit Suisse having issues is more of a shock to the market. Hence we have a down day in the market today. However, Credit Suisse, quite honestly, has been struggling for the last couple of years. Even in 2022, there was discussion of them being taken over, being merged, ultimately, what kept them afloat in 2022 was Saudi National Bank bought a 10% stake, technically a 9.9% stake in Credit Suisse. That gave them capital to continue operations. However, this morning, as it became evident that Credit Suisse was maybe needing to raise some additional capital, sort of preemptively, Saudi National Bank said, we can't put any more capital into it, largely because of their own banking regulations that say they're not going to own more than 10%, in any other specific bank or company. There's been some talk that they may be making an exception. Something may change there in the next day or two. But right now, that's sort of where the big drop, in the financial sector has been, even though Credit Suisse is the main issue from large banks right now, that's drug everything else down as well. And as we also know, the financial sector is a pretty big part of both the S&P and the Dow Jones. So while right now a lot of that risk is limited to a few select banks, the market doesn't like uncertainty. and the whole financial sector, as far as banking sector, is sort of being lumped in or being examined more thoroughly, and thus down pretty significantly here over the last week or two. So, right now, do those activities give us signs of a bigger banking crisis? Right now, it doesn't. Like I said, the only major bank to show any issues has been Credit Suisse, which has had problems for the last few years. But also keep in mind, the regulators are looking at dozens of banks every single day, when they're looking at things. And certainly we're going to see additional scrutiny across the industry because of this to make sure that banks are, shored up. They are marking things, on to market on a regular basis. But as I said, the market doesn't like headlines. So the recent events, led to the market dropping significantly, particularly on the banking side last week. Here in the last day or two, obviously it's been a roller coaster, a couple of good up days, but then here on Wednesday, back off, largely on the Credit Suisse news. It'll continue to remain rocky probably over the next few days to the next weeks as all of this, unfolds. However, I just want to touch base, explain a little of what's going on. Say, yes, we are keeping an eye, on these events and how they're impacting investments. At the moment, while it is dragging the whole market down on a daily basis like today, it's not necessarily something that's spilling over into other parts of the market at this point in time. So if you do have questions or need to talk about it, obviously feel free to email us. Feel free to give us a call, 281-872-1515. We're here for you, happy to answer any questions, talk about what's going on, or if necessary, you'll make personal adjustments based on how your personal situation as well. A real quick note on FDIC insurance for clients that do have a significant amount of cash in the bank. FDIC insurance is $250,000 per account per registration. So let me just explain that real quick. If you're married, you could say both husband and wife could both have $250,000 in there. If they're in separate accounts, both protected. You can have a joint account that has up to $500,000. So the way that FDIC looks at joint accounts, they will look at that as half is one spouse's, half is the other's. So it's still $250,000, per person. They do look at those registrations separately. So an individual account is a different category than a joint account. So the point being, even for those of you that have a lot of money sitting at the bank, double check the way those accounts are titled. You may consider, do you need to split it up? Do you need to have a little more, have one in one spouse's name, one in the other, and a joint account? But we always recommend, regardless of the bank you deal with, it's still a good idea to make sure you're staying within FDIC limits. So again, if you have any questions on any of that, or we need to talk, please don't hesitate. Give us a call or shoot us an email. We'll be here for you and happy to walk through, answer any questions you may have. Thanks.